Keith, great to speak with you once again. So let's start with taking all of last week in context and how you thought about that kind of a sell-off. Again, not the sort of sell-off we've really ever seen ahead of a presidential election, with the S&P off about 5%. And as you kind of gauge the state of the market into this event, has it changed your thinking at all around what sort of election-linked volatility we could see in the next 48 hours?
Well, great to be here with you again, Miles. Last week was definitely down 5%. That was, as you mentioned, the worst week we saw ahead of the election in some time. But when we look back heading into October, we told investors that in every single election since 1992, we've seen in October, as far as the volatility index, spike. So maybe it was more than normal, but it was somewhat expected. Another stat for you real quick, the VIX ended the month at 38. That's double the level from the last two elections as well. So I think that's just as we get closer to the election, that anxiety is building up quite a bit. And we also had the COVID numbers, move up as well. But our big story has not changed. We think we're in the early stages of an economic cycle, and we think we're in the early stages of a bull market. So what we've been telling our investors into October, and even if the next few weeks are a bit here choppy, is to lean into that uncertainty. And you mentioned a couple of things earlier about some of the sector performance. We just added in one of our more tactical portfolios more to materials last week, and we're also bullish on the industrial side as well.
Keith, you were the third guest today that has said that the bull market is intact. Just present the other side of the case. What would take the market down and ruin the bull market?
Yeah, well, there's always a risk. We always say we have a base case, and if the evidence changes, we have to change our view. But I think what would change is that the economic recovery would turn into more of a double dip scenario. We think that's unlikely because even the momentum that we saw today in the ISM and the earnings side is relatively strong. So I think, and if the vaccine got pushed out well beyond the middle of next year, I think that would be another concern, and profits rolled over. But the reality is right now we're seeing economic data still relatively stable. Even though it's being overlooked right now, we're seeing the earnings season one of the best we've seen in history as far as numbers, even though the price reaction has been somewhat less as well. And after you move past this election, the story still remains the same. You have the 10-year around 0.8%, cash earning nothing, and I think that will drive investors back into the equity markets, but they're going to have to withstand some volatility. But again, volatility doesn't always have to be a negative. In some ways, last week we were telling, again, folks to lean into that weakness.
So, Keith, if people are going back into the equity market, where should they go? Should they stick with the playbook of 2020 where you just pile into the FANG names and forget about it? Or are we nearing the point where it's time to see a more meaningful recovery in some of the industries that have been virtually shut down through all of this, like the airlines, for example?
Yeah, the way we're playing it is early this year, we were much more towards just growth sectors in general. And now we're using more of a barbell approach between growth and more the cyclical names. And our two favorite, as I mentioned, is materials and industrials. We're not there quite on the airlines as of yet. But I will say, just in general, you're seeing more of a cyclical tone. Even on Friday, when the markets sold off, you were seeing those cyclicals outperform. One area that we just recently added to in our global exchange traded portfolio was the regional banks, which have been really beat up. They're trading at about a 40% discount to the overall market, and you are seeing improved earnings and relative price trends. So I think that's a good way to hedge, because either way, we should see some more choppiness even after the election. But again, the primary trend when we're looking 12 months out is likely higher. At least the weight of the evidence in our work suggests that's the case.
And then, Keith, of course, we're talking about a lot of uncertainty, volatility around here. This would, of course, bring us to gold, which has had a huge year. And I think because we've seen such a rally in gold, there's been a lot more investor attention on the asset over the last year, let's say 2019 into 2020, than there's been in some time. How are you thinking about gold at this point, right around $1,900 an ounce?
Yeah, we think gold can make sense as a bit of a hedge, kind of to Brian's earlier. Let's say some of the scenario, maybe something happens that we're not even talking about that tanks the market. That's normally, by the way, that's what hits the market. Something we're not talking about. We're so focused on one thing, and something out of the blue comes out. So we actually added gold to our asset allocation portfolios earlier this year, just more as a hedge. As far as U.S. dollar weakness, election uncertainty, COVID numbers going the wrong way. And if you look at it, even though it's had a big run this year, you can see the last few months, it's really been consolidating, working off some of those excesses that had built up earlier in the year. So we think it makes sense, and a more modest size position.
And then just quickly before we let you go, thinking about fixed income, talked a lot about equities here. How are you thinking about that? We had a guest earlier saying that, essentially the market, or the fixed income market, I should say, pricing in basically blue wave, fiscal expansion, all that good stuff. How are you looking at that space today?
Well, we still think fixed income is important to have balanced portfolios, especially high quality. We think the 10-year treasury, we think there's going to be, if we get anywhere close to 1 or we have an overshoot or slightly above that, we think there will be a lot of buyers. So we just don't see the U.S. 10-year going much above that. We are underweight fixed income, though, and within fixed income, we have a preference for credits such as investment grade and high yield based on our assumption that the economic recovery will continue.